Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst stock.
Today we're looking at Applied Optoelectronics. If you find our talks useful, please consider subscribe, like, and comment underneath.
Right, so
Well, actually, when you look at the artificial intelligence boom sweeping the global markets right now, it is so easy to get entirely distracted by the software side of things.
absolutely.
We spend all our time analyzing the large language models, the coding breakthroughs, and of course the advanced graphics processing units that everyone is just scrambling to acquire.
Yeah, the GPUs get all the glory.
They do. But there's an entire foundational layer to this structural shift that gets, honestly, very little mainstream attention. We're talking about the physical constraints of data transfer.
The plumbing, essentially.
Exactly, the plumbing. Because you can line up the most sophisticated processors on the planet, but if the network connecting them creates a bottleneck, the entire system just grinds to a halt.
It chokes.
Right. That physical layer, the optical transceivers converting electrical signals into light to move data across fiber optics, is the exact domain of applied optoelectronics. And we really need to dissect what is happening here because the momentum we are seeing is, it's substantial.
It's massive. And that physical bottleneck you mentioned, it's really the defining challenge for cloud infrastructure providers right now. The transition taking place in data centers, it isn't just a minor upgrade.
No.
It is a fundamental re-architecting of how information flows. I mean, we are moving from a standard reliance on 400G and 800G speeds to the absolute bleeding edge of 1.6T bandwidth.
Which is a massive leap.
It is. It's about doubling the capacity of the network to handle the sheer volume of data required for training these next-generation AI models. And over the past few days, specifically on March 9th and 10th of 2026, the broader market has just aggressively repriced Applied Optoelectronics to reflect their position in this exact transition.
Yeah, and the price action alone demands our attention for you, the listener. We watched the stock gap up 21% on March 9th.
Which is a violent move.
A completely violent move for a company of this size. But then, rather than pulling back or consolidating, it followed through with another 11% surge on March 10th.
Right.
So our objective for you today is to filter out the noise. We need to determine if this 48-hour surge is just a speculative retail frenzy, or if the underlying mechanics suggest a durable, multi-year wealth-building opportunity. So let's trace this back to the spark.
Let's do it.
What exactly hit the wire on March 9th to trigger this kind of institutional buying?
So the catalyst was a confirmed order exceeding $200 million from a major hyperscaler.
Wow.
And the context of this order is what truly matters for your portfolio. This was not a routine replenishment of legacy parts. It was a first volume order specifically for their next generation 1.6T transceivers.
So they are officially in the door.
Exactly.
Yeah.
Securing a first volume order at this scale signals that a Tier 1 cloud provider, and we are talking about the tier of Amazon, Microsoft, or Oracle, has officially qualified Applied Optoelectronics technology for their new data center architecture. They are committing serious capital to the rollout.
I want to linger on the market mechanics of that reaction for a second because the volume profile tells a very specific story here.
It really does.
We saw 5.36 million shares change hands. That is a noticeable step up from their 5.12 million average, and that pushed the stock to roughly $53.69 right after the update.
Effectively shattering the implied resistance levels we had been tracking.
Shattered them. It is now actively chasing its previous 52-week highs of $59.25. But a 20+% jump on elevated volume isn't just retail traders reacting to a headline.
Far from it. That kind of sustained volume profile is the distinct footprint of heavy institutional flow.
Institutional money moving in.
Yeah. When an asset manager sees a $200 million first volume order for a 1.6T product, they immediately have to adjust their financial models. It takes the speculative revenue projections for 2026 and 2027 and just injects them with a heavy dose of reality.
Because the theoretical demand is now actual booked revenue.
Right. Institutional funds recognize that the hyperscalers are officially making the leap to this new bandwidth standard, and they are aggressively repositioning their portfolios to capture that infrastructure spend. They're buying the validation of the technology.
But, and this is crucial for anyone building a position, a top-line revenue injection only matters if the underlying engine can process it efficiently.
Absolutely.
A $200 million headline is great for driving short-term momentum, but to build sustained wealth, we have to look under the hood at the fundamentals. So let's evaluate their fourth quarter 2025 performance.
Let's break it down.
They reported revenue of $134.27 million, stepping over the consensus estimates of $131.56 million. But more importantly, their earnings per share came in at -1 cent.
Which is technically still a loss.
Technically a loss, yes, but it completely outperformed the street's expectation of a -12 cent loss.
And that fourth quarter performance shows a real tightening of operational efficiency. But the forward guidance is where the wealth-building thesis really takes shape for you.
Yeah, let's talk about that guidance.
Management is projecting first quarter 2026 revenue between $150 million and $165 million. That is a significant departure from the consensus estimate, which is hovering around $145 million.
So they are beating expectations by a wide margin.
By a very wide margin. We're not looking at gradual organic growth here. We're looking at a step function acceleration driven directly by the hyperscaler demand for 800G and 1.6T upgrades. And the long-term projections are even more aggressive.
This is where the scale of their ambition really caught my attention. Management has publicly projected they will cross the $1 billion revenue threshold for the full year 2026.
$1 billion.
$1 billion? And then they expect to scale operations to reach a staggering $378 million in monthly revenue by mid-2027. Monthly. If you extrapolate that run rate, we are discussing a company operating in a completely different financial stratosphere than it is today.
Completely different.
But here is where we need to apply some strict scrutiny. Scaling a physical hardware manufacturing operation at that velocity burns an extraordinary amount of capital.
It does. It's incredibly expensive.
So the question is, do they actually have the balance sheet to survive this hyper-growth phase without running out of cash?
It is the exact right question to ask. Aggressive physical scaling is notoriously dangerous if a company is over-leveraged. However, examining their liquidity metrics provides a really reassuring picture for long-term investors.
Let's hear the numbers.
They are operating with a debt-to-equity ratio of 0.23.
Okay, that's low.
That is exceptionally low for a hardware manufacturer in a growth phase, meaning they are not suffocating under the weight of high-interest debt payments.
Let's contextualize the working capital, too, because they have a current ratio sitting at 2.31.
Exactly. A current ratio of 2.31 indicates that their short-term assets are more than double their immediate liabilities.
They have a strong cushion.
And if we apply a more stringent stress test using the quick ratio, which, as you know, strips out inventory that might be difficult to liquidate quickly, they still sit at a very healthy 1.63.
So even in a pinch, they are solid.
Yes. These metrics tell us that while they are directing every available dollar toward capacity expansion rather than stock buybacks or dividends, they are doing so from a foundation of solid liquidity. They have the financial runway to execute this expansion.
They have the cash, and they have the $200 million order. But let's introduce some genuine friction to this thesis.
Okay, let's hear it.
If the 1.6T transceiver market is this lucrative, why wouldn't the true Goliaths of the semiconductor industry just absorb this market share? We are analyzing a company with a $3.67 billion market cap. They are competing in an arena with trillion-dollar titans like Broadcom. What is stopping a competitor with infinite resources from reverse engineering their success and pricing them out of the hyperscaler supply chain? Like, what is the actual structural moat here?
The moat is really built on two pillars. It's proprietary intellectual property and severe integration complexity.
Okay.
Applied Optoelectronics is not a middleman simply assembling off-the-shelf parts. They own the underlying IP for the design and manufacturing of these high-speed optical transceivers.
That's a huge distinction.
It is. But the true defensive wall, the reason a hyperscaler doesn't just switch vendors to save a few dollars, is the physics of AI data center architecture.
Walk us through the mechanics of that, because upgrading from 800G to 1.6T isn't just about widening the highway, is it?
Not at all. It is about the flawless synchronization of thousands of components operating at light speed. When a Tier 1 cloud provider trains a trillion-parameter large language model, they're coordinating tens of thousands of GPUs simultaneously.
Thousands of them, all talking to each other.
Right. And if you swap out an optical transceiver, and the new component introduces even a microsecond of latency, or if its thermal output requires a different cooling protocol, the entire cluster falls out of sync.
The whole system just stumbles.
The GPUs sit idle waiting for data packets to arrive. And in the hyperscaler business, idle compute time costs millions of dollars a day.
So by securing this $200 million first volume order, Applied Optoelectronics is essentially hardwiring their specific technology into the nervous system of this new data center.
That's a great way to put it.
And once they are integrated and optimized, the switching costs become prohibitive. The risk of crippling a multi-billion-dollar supercomputer just to test a different supplier's transceiver is simply too high for these tech giants to stomach.
Precisely. High switching costs create one of the most durable economic moats in enterprise hardware. Furthermore, the company is actively reinforcing that moat by aggressively expanding their internal manufacturing footprint in Texas and Taiwan.
So they aren't relying on someone else to build it.
Exactly. They are not entirely dependent on third-party foundries scattered across the globe. By keeping tight control over their geographically diverse production lines, they are targeting a production capacity of over 500,000 units monthly by the end of 2026.
Over 500,000 a month.
Right. This allows them to guarantee supply chain reliability to the hyperscalers, which is a critical advantage when competing against larger players who might be bottlenecked by outsourced foundries.
The combination of high switching costs and robust manufacturing control certainly explains the bullish sentiment radiating from Wall Street right now. I mean, analysts are rushing to update their models.
They really are.
We saw Rosenblatt maintain their buy rating while aggressively raising their price target from $125 to an eye-watering $140 a share.
A very bullish target.
B. Riley also issued an upgrade, specifically pointing to the surging infrastructure demands originating from Amazon. Additionally, the market is actively digesting rumors about expanded multi-year contracts being negotiated with Oracle and Microsoft for future 1.6T shipments.
The analyst upgrades and the speculative chatter surrounding Oracle and Microsoft certainly paint a very optimistic picture.
Right.
But as an objective wealth builder, you cannot afford to blindly follow the momentum.
Right.
We must thoroughly dissect the bear case. We have to look at the severe pressure on their profitability metrics, because the current numbers are alarming.
They are.
Despite the surging top-line revenue, their net margins are deeply negative. They are currently sitting at negative 36.97%.
Furthermore,
Their return on equity is at negative 7.34%.
wait, hold on. Let's not gloss over that. A negative 36.97% net margin is a massive vulnerability.
It's a huge hole.
They're losing over a third of every dollar that comes through the door. I understand they're spending heavily to scale up the Texas and Taiwan facilities before the 1.6T revenue fully actualizes, but how can we confidently say they won't eventually need to dilute shareholders to plug a hole that wide?
That's the primary risk.
Especially when we look at recent insider behavior. In the most recent quarter, corporate insiders offloaded 66,520 shares. That equates to roughly $3.08 million in stock sold. And crucially, this included selling from the chief financial officer. If the person directly managing the balance sheet is taking millions off the table during a hyper-growth phase, that requires our strict skepticism.
Your skepticism is entirely justified there. Insider selling, particularly from a CFO, is a glaring risk factor that must be monitored. The cost of scaling advanced hardware manufacturing is unforgiving, and the negative 36% margin reflects the harsh reality of front-loading capital expenditures.
Right.
However, to maintain an objective view, we must weigh the insider selling against the broader ownership structure, because total institutional ownership remains unshakable at 61.7%.
So the argument is that if the negative margins or the CFO's stock sales were truly indicative of an impending financial collapse, the large mutual funds and asset managers wouldn't be holding that 61.7% stake.
Right.
They would be sprinting for the exit.
That is the logical deduction.
Wow.
Institutional money managers have deep visibility into the supply chain and margin trajectories. They are holding firm because they see a mathematical path to profitability.
Which is?
Management has established a definitive target of achieving a 30% gross margin. The thesis is that once these $200 million first volume orders transition from the announcement phase to actual scaled production rolling off the assembly lines, the unit economics will flip.
Because the fixed costs of the factories will be spread over a massive number of units.
Exactly. The near break-even earnings per share guidance for the first quarter of 2026 suggests they are already executing on that trajectory.
Okay.
But make no mistake, operational execution is the single greatest risk. Any delay in hyperscaler deployments, any yield issues in the Taiwan facility, or any sudden technological leapfrog by a competitor makes that path to profitability significantly steeper.
With the bull case and the severe margin risks clearly laid out, what timeline should you be tracking to evaluate their execution? Let's map out the catalyst calendar for the next few quarters. The immediate milestone will be the Q1 earnings report. anticipated in late April or early May of 2026. The guidance places earnings per share somewhere between -9 cents and 0.
Right.
If they can successfully hit that 0 mark or deliver a surprise profit, it will serve as tangible proof that they are scaling efficiently, and the market will likely reward that execution.
And following the Q1 earnings, the next critical juncture arrives early in the third quarter of 2026. This is the projected window for the physical shipments of the 1.6T transceivers to actually begin ramping up.
When the rubber meets the road.
Exactly. Announcing a $200 million order generates momentum, but recognizing the revenue upon delivery validates the balance sheet. Tracking their ability to meet those shipment deadlines without production hiccups will be vital.
Beyond the company-specific calendar, there are significant macroeconomic tailwinds providing structural support to this sector right now. The broader AI data center capital expenditure cycle shows zero signs of fatigue.
None at all.
Every major technology company is engaged in an infrastructure arms race. Furthermore, if we see anticipated interest rate cuts materialize, the cost of capital for these multi-billion-dollar data center projects drops.
Which changes the math entirely.
Cheaper capital historically fuels a sector rotation, driving even more investment directly into semiconductors, hardware infrastructure, and bandwidth solution providers.
Synthesizing the technical validation, the robust liquidity, and the severe profitability risks we discussed, the overall bullish score for Applied Optoelectronics stands at a firm 8 out of 10.
That's a strong score.
It is. The core wealth-building thesis is compelling here. This represents a potential multi-year hold, driven by a confirmed $200 million catalyst, an aggressive capacity expansion targeting 500,000 units monthly, and the formidable switching costs inherent to AI data center networking.
Right.
The negative net margins and recent insider selling present real operational risks, but their accelerating revenue guidance and low debt ratios provide a well-funded runway for management to execute their margin turnaround.
It is a profound shift in how we evaluate the infrastructure of the future. The transition to 1.6T speeds is a structural necessity, not a passing trend. And I want to leave you with a final provocative thought as you continue to analyze this space.
Let's hear it.
We devote countless hours debating the intelligence of software algorithms and the brilliance of the companies writing code. But if the absolute physical limits of light-speed data transfer remain the ultimate bottleneck restricting artificial intelligence, who truly wields the leverage in this technological revolution? Is it the software developers pushing the boundaries of machine learning, or the hardware manufacturers producing the digital plumbing that prevents the entire ecosystem from choking on its own data? Thank you for joining Smart Wealth with Joshua today.